Hello guys and girls, and welcome to episode 7 in Quick Tip Season 3. Very excited for this episode. So we're going to be discussing management with a bit of discretion and really show you how you can simplify things. Now there's a few simple things that I do with my management just to keep that process really easeable, scalable as well, which is really important, and sustainable. It's important that you backtest your management strategy. I'm going to give you some exercises at the end that you can do that's really going to improve the overall performance. But let's start off with some examples. Let's get into the management. So first up, we have New Zealand CAD, and we're looking at this particular trade at the top of the structure. Now, top of the structure is key. So there's a few things I want you to focus on with the management, because I do know it's an area that we overcomplicate. So how do we look at it? Well, it's not just black and white. You can manage every single position the same, because price isn't always exactly the same. But we can have a guideline of what we can look at. Now, for those of you that haven't seen, definitely check out my longer term approach in this season. So you can look how I'm managing more of the longer term approach, slightly more relaxed. But let's look at the more short to medium, how we manage the majority of the positions. So New Zealand CAD, first up, we're looking at this trade at the top of the structure. We can see we have this 1, 2, 3. Of course, this is a high probability setup. Then we go to the 1 hour and we're looking at a trade like this. The key thing that I want you to take away from this is that when you're at the top of the structure, this is very important, I want you to write down, when you're at the top of the structure, you don't move your stop to break even very quickly, even when you're in 1%. Now, if there was ever a reason to not move your stop to break even, it would be at the top or at the bottom of a structure. Why? Because price can move down. You can technically be in 1% or 0.9, something that you might think is justified to move to break even. It kind of trickles way sideways, takes you out for break even, and then drops. Now, I know exactly how you feel, because a lot of you have probably felt this way of feeling a little bit frustrated that you get taken out for break even, then it moves in your desired direction that you forecasted. We've all been there. Now, sometimes this is unavoidable. You will just be taken out for break even and it moves in your direction. But on the flip side, the amount of emotional side effects that you've saved yourself from taking unnecessary losses is also key with the break even method. So how would we manage this one? Well, we have this 1, 2, 3, very clean structure, middle section, and then we're looking at this ascending channel. Let's say, for example, you took this trade with a 1 hour retrace or anywhere within this structure. Right at the top, let's say you got in here, wouldn't it be unreasonable with a 20 to 25 pip stop? Let's call it 25. Now, technically, as this price moves, let's play this back to around, let's go to about here. So technically, you're triggered into the trade, and price starts moving in your direction just a little bit. And at this point here, technically you're in 1%. So we could argue, well, we can move that to break even now. You have to look at the price. This is why it's important this is what I call discretion, rather than, if you looked at it from a mechanical point of view, well, technically it's 1% to move to break even. Well, where are we within the structure? Are we at the top of the structure? Are we just in a tight flag in the middle of nowhere? Or are we right at the top of the structure with lots of room to the downside? High probability, 90% rule. We've got 13% on the table. So do we want to choke it around these areas? Probably not. So that is that tiny little bit of difference between mechanical, which is just 1% move to break even, or actually use your initiative. Look at the top of the structure, realize that, well, it is technically 1%, but this is corrective, and this kind of looks corrective. So we can just trickle our way up a little bit and still drop. So it's about using your initiative in that process. Let's move this out of the way for a second. Let's play that. So as we move sideways, technically there, you'd be taken out for break even, right? It just would have trickled you up. Now, when you kind of look at that, there's almost just nothing. It's just nothing price movement, just moving up just ever so slightly, take you out for break even, and then it moved in your direction. Now, if this did happen to you, you could feel kind of frustrated, but that's because you approached it in a mechanical fashion. Now, you guys and girls know that I'm not really a fan of mechanics, and looking at it from that kind of systematic approach, of course, you have to have some level of guidelines, but you have to use your initiative in these areas. So again, even looking back at it from that perspective, it only ever so slightly, you could use structure, always use structure for your discretion. When you're looking at it like this, 1, 2, 3, the question you want to ask yourself, it's pretty corrective. Technically, it's a 1%. Let it actually impulsively break something first before you actually lock in any profit or move it to break even. Now, on the flip side, you could say, well, it was at 1%, so I could have, taken me out for a loss if it trickled its way up. That's fine, because if there's ever a reason for you to take a 1% loss where you feel good about that, and you know that something you can stick to over and over again is high probability setups at the top and the bottom of the structure, I honestly believe and firmly believe this is a powerful 1% tweak that so many people are not doing. and you're just moving it to break even just because you see 1%. Like I said, I've never ever said as soon as it gets to 1%, technically move to break even. It just so happens subconsciously around those areas that it is around 1%. It could be 1.2, could be 1.3. It really does depend on the structure. But if you're literally, as soon as you see that 1%, bang, break even, that is going to leave you a little bit frustrated if you're not looking at it in terms of where are we within the structure, what's the pattern showing us, is it corrective, is it impulsive? Because you could be at 1% here, for example, and then it literally just trickle its way ever so slightly, take it off break even, then drop, and you think, why did I move to break even? You got to look at the bigger picture and ask yourself, what's the risk to reward again? Okay, we're looking at a 13 to 1. So do I want to choke that for the sake of that, or do I want to be a little bit more relaxed? So it's knowing when to be lenient with your stop, which is at the top and the bottom of the structure, and when to be aggressive. So a tiny little lesson, but I promise you, if you backtest the top and the bottom of these structures and realize when that happens, it's going to save you so much percentage rather than that frustration. So that is New Zealand CAD. Let's take a look at the next example. So next up here, we have dollar CAD. Let's take a look at this example. So look at the high time frame structure. We're looking at a big impulse, looking for this continuation to move to the downside. Now, what I want you to pay attention to is this drop that we're looking at here. Now, arguably, you wouldn't know where the trend line is, right? You wouldn't know to have it there at this point in time. We could look at it in terms of, well, this is parallel. We would be forecasting this, which we was, as an impulse, bigger continuation. So we would expect some sort of parallel type price movement before this then comes to the downside, forms a correction, right? But we've got to look at it in the moment. What would we be looking at? Well, we'd have the ray line like so, and we'll be looking at this potential rejection. If we go to the lower time frames, we go to the 1 hour chart, we're looking at this. Now notice how with this high here, what do? We actually get here very, very correctively. So this is a trade that we may have had an entry on for a retrace. Some of you might have got in risk entry and maybe taken a 1% loss. Some of you may have put an entry here and just never got triggered into the trade. Then what happens after? We impulse up, and then we're looking for continuation to confirm that. But what happens? It starts to form more of an ascending channel, right? It starts to form more of this corrective nature here, like so. And then we're looking at this type of price movement. It almost forms an extension of this pattern. And we see that quite commonly when we just break a high impulsively. We're waiting for a solid continuation to take it higher, or we're seeing if it forms a rising wedge or an ascending channel, which is normally an extension of the pattern to then come and then drop back down, which is catching people on the wrong side before it drops. So at this stage, once we actually start to get a bit of a rejection at the top, it's then safe to say that we can put that line in as just as a guide, because it's not to do with it's just one tiny rejection, then we quickly move the trend line there. It's more to do with the fact that we're expecting this drop anyway, and we've broken above here, and we're seeing this is getting people caught on the wrong side of the market. It's parallel to this. That makes sense for us, and we've seen these structures play out, and we've backtested them time and time again, that this really and truly can just be part of all of the move. It's just a deeper ascending channel. It's got more of this expanding type feel to it. And then we've got that ascending nature right at the top. But let's say, for example, you use the same approach as I previously said with New Zealand CAD, that essentially this is at the top of a structure, top of a pattern, high probability area that we're looking for a downside move, playing it down here. Let's say, for example, you do take that trade, and let's neaten that up. Let's say you take it on the break, let's do a bit of pattern separation. You take it on the break here of that ascending formation here, right? If you're taking it on the break here, and you've got your stop just above, let's say call it 30 pips. Technically, at this point, you get to 1.8 with the wick, right? 1.8 there. Let's move that out of the way ever so slightly. Very big spike there. This is what you utilize your discretion. So technically, it's been at 1.8. So you could say, yeah, let's move to break even straight away. But what you could have a look at, and Neil actually covered a video on this, this is a great example of utilizing your discretion in this moment, is taking a look at this. If you would have moved it to break even, then this move here, this little spike would have taken you out for break even. But wait, the key tip, the quick tip that I want you to note down is when you're looking at something like this, before just looking at where price is, wait for the candle to close before making your decision. Because in the moment you might see it down here and think, all right, quickly move it to break even, but the candle hasn't closed yet. If it completely retraces like so, then it's a big, big retracement candle. It might just be trickling its way down and then drop, right? So wait for the candle to close if it's at the top of the structure or the bottom of the structure. So there's a key detail there. Wait for the candle to close if it's at the top or the bottom of the structure. Don't just do it in any kind of ordinary reduced risk flag, because that is what the break-even method has been predicated on. So it's about utilizing that there, because you would have been taken out for break-even, then shortly after, it then carries on. If you didn't move it to break-even straight away, and you let this play out, and you used a bit of discretion, which is normal, because you're at the top of the structure, you don't want to choke it there, you may have been taken out by this little wick if your entry was a bit lower, or the spread, or you might have just stayed in. That was one of those ones where some people would have stayed in, some people wouldn't. But regardless, right, you can see the differences there is knowing when to be lenient at the top and the bottom of the structures. And we will emphasize this over and over again. And after speaking with the coaches and speaking to what is the common thing where people do actually struggle to get consistent, it's normally a couple of things. It's the ability to understand high probability trades versus your valid trades and average trades that are just really not fitting your plan and structure. And then actually understanding how to just have a simple process for management. Some people have 7 different variations of how to manage. The truth is, sometimes you just need to give things a little bit of room to breathe and then actually understand when to do that. Top, bottom of structure. And feel confident and be proud that you're sticking to your plan. I think that's the most important thing. Remember, your management plan is not going to be exactly the same as somebody else's management plan. Some of you may prefer just to be super aggressive with your management all the way through, and that's fine. But then on the flip side, you will have to deal with the fact that sometimes you can get taken out for break even at the top and the bottom of the structures. And then guess what? Some trades will go and play out for 10%. But if you're fine with that, and that's better for you from an emotional perspective, then stick to your plan, but don't compare that and try to copy someone else's plan if it's just not true with your personality. So you have to take that on board as well and really reflect on that. But for me, and like the majority of successful traders that I see, we keep things simple with 2 processes. If it's a reduced risk flag, just a type flag that will show you, move to break even after impulse is down. Typically when it's over that kind of 1.3%, it's not exact mechanical, but you get the point. But when it's at the top and the bottom of the structure, you be a bit lenient with it. So very, very simple. And if you would have left that, you would have ended up probably getting taken out around here for about just under 4%. So it's a tiny little difference, but you got to imagine you take 2 or 3 of those trades per month, and then you're adding an extra 3% here, 4% there, 3% there. You could be adding an extra 7-8% to your trading account. And then if you're taking losses, it could literally be the difference of you being in -4 or +6 or +4. So it can literally take you from an inconsistent trader where you feel like you don't actually know what you're doing to a point where, okay, I'm making great progression. I'm in +3 this month, +4, and I'm building on that. A tiny, tiny little 1% tweak, and just a quick tip for you all. But moving on to that. So the next way that I manage. So right now I've showed you at the top and the bottom of these type of structures, right? It doesn't always have to be right at the double top, but I'm talking about top of a pattern or a structure. Let's say, for example, we're looking at something like this. Now, this is a no-brainer. This is simple. This has never changed. So when you're looking at something like this, now after this particular pattern broke down to the downside, there's a few things in here where you would have, if you took this trade, you probably moved to break even and then you got taken out for break even. That's fine. You could be a little bit more relaxed with it because it's at the top of the structure. So 2 ways there. Do what's comfortable for you. Now, after this impulse is down, I believe this is about 3.5%. So moving back and being taken out to break even, of course, is justified and normal. Then at this point, we then get another opportunity to be able to be taken into trade here as well. There's a 15-minute flag within here. But this is the obvious one that we see a lot. The first solid continuation pattern after the first impulse. This is the one that we want to pay attention to a lot. So we can see we've impulsively broken the structure, and talking about management in terms of locking in profit as well, just touching on that. As a quick tip here, we've already established that this is moving down, moving back up. We've of course got this little structure, this ascending formation that we have here. Looking at this kind of ascending structure, right at the top, we can see this is essentially topping out, if you like. If you're going to lock in profit and you're taking a trade here, you really want to wait for a solid impulse. I'm talking about something like this. Before you start locking in any profit, you want to close. See how this is closed, an impulsive close? Rather than as soon as it gets to here, start, locking in profit around there, because it could just hover, take you out for a tiny bit of profit and then drop. So wait and look at the structure. And this is why you can't manage exactly every single trade the same. You have to look at the current structure. See, if we was to look at Euro Yen, for example, of a similar structure, this is nearly 100 pips. Another one we could look at is 30 pips of the structure, and it's tighter. So that's why you have to look at the overall structure and wait for a significant break. As you can see, a significant break. If, however, then we get a significant break and you start to see these retraces, then it's justified locking in a bit of profit and moving it to break even, because it's probably going all the way back up to the top of the structure. So it's just using your initiative there. And as we move down, so this is the correction that's filtered on the 15-minute, ready to set the entry, triggered in as it comes back up. That spike either took you out for break even just due to NFP or the spread. And when you look at that structure, if you took it on the 1 hour, which is why I talk about utilizing the 15-minute, there's no reason why all of you can't use the 15-minute, but only as a filter on the 1 hour structure. Stop searching for 15-minute trades. You don't need to. The 1 hour has been more than enough for years and years and years and years of tested data. The 15-minute is purely a filter. So on something like this, as you know, this is a trade that I took, but on the 15. Now, what does that give me? A tiny edge, because I'm able to get in true on the reduced risk entry. So of trades like this, whether it's a pennant or a flat continuation, when you're taking the trade like so, you got a 20 pip stop or 25, and we get a significant close. We've closed there for 1.5. Now, if we just replay this back to here, this is really important. So when we're looking at this structure here, and we close like so, here we go. So we've closed now. We've got a solid close. We're running at 1.38. There's no real wick within it. It's just a solid close. And at 1.38, that makes sense. Why? Because we're not at the top of the structure. We've had our first impulse, first correction. And at this stage, if we do retrace on the first correction, then we know it's very likely it's just creating a larger structure. So this is where unnecessary losses take place. And then what happens? It creates a larger version of itself, like a Falcon flag. And then you're still emotionally hesitating now because you took that 1% loss because you allowed it to completely retrace and you didn't utilize the break-even method. And it's not in the fact of taking the break-even. It's not the 1% loss, because at the end of the day, we're capping our losses very, very low at 1%. It's not taking the next trade that makes you 9%, which is the tip there. That's the issue with the people's trading. So what I found is the break-even method protects that psychology, and it's helped me out massively. Now, what you could do is you could go and test and see a lot of trades where if you just left them all open and you never moved your stop to break even, then a lot of them would, play out. A lot of them would play out more profitable, even if you did take the extra losses of the 1%. Mathematically, that might be true. But again, that's just the typical hindsight-minded trader. That if I left this would have happened. If I would have crossed the road then, I wouldn't have got hit. Or if I would have picked 7 instead of 6, I would have won the lottery. It's constant hindsight. But what we can do is look at it in a formation of, well, what's sustainable and what's scalable? Well, if you look at it on bigger capital, do you want to trade that way and just leave them all open? I highly doubt it. Letting those profits pull back very deeply, I highly doubt it. So it's about understanding that the break-even method from a psychological perspective will advance you much more. I highly, highly expect that the ratio of successful traders, you have a much higher chance to succeed by utilizing the break-even method than you wouldn't if you was to just let them run. So you could look at the maths and say, well, if I just leave all the trades, they'll probably play out anyway. Well, let's look at the emotional drawbacks to that. That will probably set you back years and years on your journey, because you're constantly feeling emotional and feeling, attached to the money and things like that. So the fastest way to remove that is the break-even method. And I found that to give me more clarity in what I'm doing, as well as I'm seeing so many in the community do the same thing. So just some quick tips there, but very, very vital. Top of the structure, typical impulse correction, reduced risk, no wick there, solid close. If it retraces, take the break-even, you look for the re-entry. That is the key detail in that. So I hope that helps and you've taken down some quick tips. Let's look at the next one. So the last example here on pound Aussie, let's take a look at this structure. So we're looking at this overall bigger move to the downside, this expanding. We have the double top, we've had our first impulse, and we're looking for some kind of corrective structure to look for continuation. We go to the 1 hour chart and we take a look at this. If you remember this particular trade, a lot of us did take this, and we're looking at this structure. Now at the time we haven't got this, so we've got to move price back and take a look at what the thought process would be. So at this point, we're looking at it in this formation. And this is just another tip within this quick tip, actually, is that what people can often do is they can look at a price structure and just take it out of anywhere. Now, someone might look at this and say, isn't this an inverse head and shoulders, right? I'm going to look for that, or the start of one, or very close to one, to look for upside. I wouldn't want to sell that. But the truth is, where is it within the structure? If you took price here, for example, and then put it there, that's a different story, because then we're at the bottom of the structure. Then we've got an inverse head and shoulders, we're looking for buys. But if it's in the middle of the structure, it could be anything. So at this point, you could put this on, which I remember I had, and we've got this top line, and we're looking for any kind of 1, 2, 3, any kind of rejections in these areas. Let's say we take this trade around now on the break of that structure, like so. Got the retrace the ascending channel. We're very well aware, of course, this can do two things. This is how we'd be forecasting. Impulse correction, again, just another example in a management perspective. Look at this, the first correction after the move down, right? Impulse down, move it to break even, let it do its thing. You stay in the trade. So at this stage here, we're looking at it and understanding, well, we can come down, we can actually hover and then just drop. Or we can come down, we can come back up again and maybe form a bigger structure, take a break even, then re-enter, because this could actually go a lot higher. So we protect ourselves in that sense. So how do we play out and how can we deal with that? Well, in this one, what happens is we get triggered in right here, move it to break even. We're in taking this trade at about, so anywhere between 25 to 30. Let's call it 30 to be conservative. So at this point, we're in 1%. You know, after that candle closed, it was in about 2% at that point, but it hadn't closed. But even when it closed, just about 1%, right? Some of you might be in a little bit more if you took a slightly tighter stop. But when you look at that, this is a prime example of moving it to break even, just like a reduced risk flag, because we're not at the top of this particular structure. We're just in a smaller pattern within here that isn't the cleanest, because we're anticipating more of this structure to develop. If, however, we had an impulse, a move up like so, and we're looking at something like this, and a third touch here, and we've got a cleaner defined pattern, because at this point we don't even have two bottoms here. We're just looking at this as maybe an expanding structure, and we're just making sense of it, right? If we have something that's slightly more solid, that's a little bit different. But at this point, this could just tag you in, just move a little bit higher and form a different pattern. So we can see that from the structure. This is why you can't just look at something so black and white. But in this situation, you know, some of you might have left this open. And again, you got to remember, worst case scenario, you're only taking a 1% loss. So these are just tiny little tips here. But if you move to break even, see what happens. Again, you would have been taken out for break even there. And there's the re-entry, right? There's the re-entry for the trade. Should you have taken a break even then? Well, yes, because it's all about the re-entry of the trade as well. So it's about actually looking at it from that perspective and realizing, well, this one did re-enter, but when that moved up, that could have taken you out for a 1% loss in a structure that wasn't really the clearest at the time in the moment, right? It looks clear now in hindsight, but in the moment, it wasn't as clear as what you might think. So it's about utilizing it in those moments. The one impulse candle doesn't put me off or anything like that. That's why we take the trade. It's just really about utilizing that after and realizing, okay, this is a point where I can move it to break even and utilize my initiative there. So just a tiny little tip. And again, just making sure that you're sticking to your plan. Eventually it does play out and it gives us this type of structure. And then we start to form this move and we go a lot higher. So again, it did give us another point of entry anyway. So just remember this as well with your management. What you can do to give yourself a little bit more confidence and comfort is know that the majority of the time we do get 1, 2, sometimes 3 opportunities to enter. So moving to break even is a good opportunity to protect your psychology so you can think with clarity and say, right, do you know what? I can move this to break even because we probably get another entry anyway.